This market sell-off has been brutal, and investors, they're on edge. The big question is, are we on the brink of a full-blown stock market crash, or is a reversal on the horizon? With the VIX spiking, let's break down exactly what the data is telling us right now. Now, referring to the VIX, what is the VIX? It's a volatility index. It measures a premium on the options on the S&P 500 over the next 30 days. When the stock market goes up, the premiums shrink and the VIX tends to go down. The VIX is also called, by the way, the fear index. Now, again, when markets decline, the premiums tend to rise on the options, and that makes the VIX go up. When markets rise, the VIX tends to go down. When we see VIX indications of 15 or less, it's usually indicative of very strong bull markets. When the VIX is between 15 and 20, moderate bull markets, but with some volatility. 20 to 30, uncertain trends, slight market corrections. And the VIX 30 and above, well, that we start talking about bear markets, the risk of recession, deep market corrections. In blue, S&P 500. In red, the VIX. We can see almost a perfect negative or inverse correlation. Let's go back in time, 2001. Very quiet markets in the midpoint of 2001. The VIX was down near the 22 level. When the tech bubble got itself in a lot of trouble, the VIX spiked up to 44. In 2008, we had a financial crisis. Before that, we had very quiet markets in the middle of 2008. The VIX was at 21. But when the financial crisis began, we saw the VIX spike all the way up to 80, a huge level. That is really indicative of how drastic that selling was in 2008. So what does the data tell us now? Well, this is an interesting experiment. The x-axis at the bottom, that's the VIX. That's the 2025, that's the readings for the VIX. On the y-axis on the left-hand side, that's the average forward performance for the S&P 500. So pretend the VIX is at 20. How, on average, does the stock market, the S&P 500, perform over the next 30 days? Well, right now we have a VIX of 2786. Statistically speaking, and we have several decades of data, statistically speaking, the S&P 500 tends to go up about 1 to 2% when you see a VIX between 25 to 30. If the VIX were to rise up to 55, well, that's catching a bear market and a severe market crash, right in the middle. And we tend to see follow through. But when that crash really hits the bottom and we see VIX levels, let's say it's 60, that is usually followed, statistically speaking, by a 6% recovery over the next 30 days in the S&P 500. Well, how about 60-day performance? Again, right now we're 2786. And statistically speaking, we tend to see over the next 60 days a 2.5 to 3.7% return on the stock market. If we were to see the VIX up near 45, that tends to return around 5.5% over the next 60 days. And then if we see a VIX at the 55 level, well, that's in the middle of a correction. So you see, essentially, when we see a VIX 15, 20, 25, even approaching the 30s, although it might be a bumpy road, it's still indicative of a long-term trend that tends to be intact. But when we see the VIX, especially above 40, 45 into the 50s, that means we're in a lot of trouble. How about the 90-day performance? Well, right now, VIX at 2786. That tends to return around 2.4 to 5.3% over the next 90 days. If we were to see a VIX indication near 45, that is usually indicative of a severe market sell-off and then a 9.8% bounce. But if we see VIX up near 55, that means trouble, and we would tend to see the market go even lower and the VIX go even higher. So where are we now? Again, the VIX right now is at 2786. We're slightly above that a couple days ago. And essentially, again, according to the data, if data is any guide, that although the road has been bumpy, we're still in a level, especially as long as the VIX stays below the 30s. We're still at a point where we should expect to see a bounce, maybe only a couple percentage points over the next 30 or 60 days. But Usually, we tend to see bounces at this level, although I know the selling has been quite severe. But if we do have some sort of black swan event that sends the VIX into the 40s or the 50s, well, now, we're looking at a severe market correction. So again, a VIX between 25 to 30, statistically speaking, is not a severe reading, although the markets have felt quite severe lately, and it's usually indicative of a minor correction over the long term. On the economic calendar, we have some big news this week. Tuesday, job openings. Wednesday, consumer price index. Thursday, producer price index. Certainly enough reason for the market to move if it's caught off guard. We hope this has been helpful. We look forward to seeing you back soon.